Good morning, ladies and gentlemen. Welcome to the latest in our series of private client and entrepreneurial business focused webinars. Today, we shall be talking about tax efficient investing. My name is Patrick King. I'm a tax partner at MHA, and I'm joined today once again by James Kipping, another of our partners based in our city office. And finally, today I'm also joined by Scott Newbold from our financial services arm, MHA Caves Wealth. So what will we be covering today? Well, we'll talk a little bit about what is tax efficient investing. We'll look at what is EIS, what is Enterprise Investment Scheme, what are venture capital trusts, and then benefits and risks and who should actually invest. So James will do quite a bit at the start. I've got a few slides on some of the more extreme versions of tax relief you can get when you use Enterprise Investment Scheme in tax efficient planning, which shows how surprisingly good it can be. And Scott will talk us through how who should be investing and the risks and so on. So without any further ado, I shall pass you on to James to take us through the first bit, please.
Thank you, Patrick. So just before we start, I just confirm that if you've got questions as we run through, could you use the Q&A function, which should be on the toolbar, and we'll either answer them, or rather a colleague will answer them in writing if she can. Otherwise, we'll go through them at the end, and there should be, I think, 10 or 15 minutes specifically for questions at the end. Right. So, as by way of introduction, I suppose when it comes to tax efficient investments, the most obvious vehicles that come to mind are pensions and ISAs, and of course they're both very well known. And both continue to offer generous tax reliefs, albeit that they are often severely restricted, particularly for higher earners. And in particular, the tax reliefs associated with pension contributions have been heavily restricted in recent years, with the highest earners, and by that I mean those with income of more than about 300,000 or so, are only able to make pension contributions of up to £4,000 per annum with tax relief. This is because the standard annual allowance for pension contributions is reduced from 40,000 down to as low as £4,000 when someone's income exceeds £240,000. Just by way of to put that into some context, the pension contributions annual allowance was as high as 255,000 back in 2010-11. So you can see how over the last decade or so, people have been severely restricted in what relief they can get for example, pension contributions. And during this same period, the lifetime allowance that applies for pensions, that's the overall limit on tax privileged pension funds that you can accrue during your lifetime, has been reduced so that it's now just over 1 million, precisely 1,073,000, and it will remain at this level until at least 2026-27. In fact, that may well be extended beyond 26-27 on Thursday. This has, of course, led to the highest earners looking elsewhere to secure tax relief for their investments, and venture capital schemes such as the Enterprise Investment Scheme, the Seed Enterprise Investment Scheme, and venture capital trusts provide generous tax breaks for investing in essentially unquoted early stage or smaller qualifying trading companies. And it's these types of investments that we want to talk to you about today. I'll run through the tax reliefs for investments made into these products. It's important also to emphasize that they are established and well understood reliefs. They're likely to be around, fingers crossed, they're likely to be around for some time to come. EISs and VCTs were introduced in the 1990s, for example, and have been pretty much, or rather the tax reliefs have been pretty much the same ever since. SEIS, that's the Seed Enterprise Investment Scheme, is a much more recent scheme introduced to complement EIS, and I'll cover that briefly later on in the talk. So moving on specifically to the Enterprise Investment Scheme, or EIS. It's a venture capital scheme that provides a range of tax reliefs for investors who subscribe for shares in qualifying trading companies. So crucially, you have to make the initial subscription. It's not a sort of second-hand purchase of shares. Now, not on the slide here is just the conditions that need to be satisfied, both in terms of the investor and the company, to qualify for reliefs. Now, I'm not going to go into huge detail, but just so you kind of understand the types of companies that might qualify under the enterprise investment scheme, I'll cover the main conditions briefly now. So in respect of investors, the individual must not be connected with the company, and broadly that means they mustn't have a 30% or more interest in the company, and the individual must not be an employee or a paid director, with the exception being for so-called business angels, who must have received their shares before becoming connected with the company. In respect of the company itself, it must be unquoted and have a permanent establishment in the UK. It must not have gross assets exceeding 15 million, and that's before the investment, and 16 million after the investment. It must have less than 250 staff, and it must not be under the control of another company. Those limits are increased for certain knowledge-intensive companies. And finally, it must be undertaking a qualifying trade. And there's a kind of a list of excluded trades, which include things such as legal and financial services and property development trades as excluded activities. So those trades will not qualify. Now, moving on to the tax reliefs themselves, there are 5 key reliefs available, and I'll run through each in the following slides with examples, keeping them hopefully as simple and as understandable as possible. Firstly, income tax relief. So income tax relief at 30% is available on subscriptions. So if an individual invests £100,000, they can claim £30,000 as a reduction in their income tax liability for the year of investment. In fact, they must have therefore have a tax liability of at least £30,000 to claim full relief. But it is possible, if that's not the case, to carry back subscriptions to a prior year, or rather the previous tax year, to maximise the relief available. So really you're looking at claiming the relief for the year of investment and or the previous year, if that puts you in a better position. The second relief is capital gains tax deferral relief. And here, capital gains realised on other asset disposals can be deferred into enterprise investment scheme subscriptions, and those subscriptions must be made in the 12 months before or 36 months after the disposal of the other asset. So essentially you have 3 years after a disposal that would otherwise be charged a capital gains tax to make an EIS subscription to defer that capital gains tax charge. The gain comes back into charge at the prevailing CGT rate when the EIS investments are sold. But if you die holding the EIS shares, the deferred gain will die with you. So if someone's able to take advantage of the income tax and capital gains tax reliefs, this example on the first sort of set of numbers on the slide here shows how the combination of reliefs can significantly reduce the net cost of the investment. So say someone realises a gain of £100,000 on a disposal of residential property, on which the capital gains tax rate would ordinarily be 20%. By investing this amount into EIS, the net cost of investment, when coupled with the income tax relief that's also available, is just £42,000. Now, the second part of the example here on the slide shows that if the EIS shares are then sold in 3 years' time, say, for £100,000, so they're sold for what you bought them for in the first place, the deferred gain comes back into charge, but it comes back into charge at the main rate of CGT at the time. Currently, that's 20%, which in this example would leave net proceeds after paying your capital gains tax of £80,000. So by retaining the shares for 3 years, the income tax relief is preserved. It would actually be withdrawn if the EIS shares are sold sooner. But that means the individual has made in this example, has made a profit of £38,000 on a net investment of £42,000, which equates to a net return of just over 90%. The EIS shares themselves, provided they are held for 3 years, qualify for capital gains tax exemption. In other words, capital gains tax is not applied to profits made on the sale of EIS investments, provided those investments are held for at least 3 years. So following on from the previous example, the net cost of a £100,000 investment is £42,000 after taking into account maximum capital gains tax and income tax reliefs if they're available. If the shares are then sold for £125,000, the deferred gain comes back into charge at 20%, as in the previous example, and the individual is left with £105,000, which again is compared to the net investment or net costs after the reliefs of £42,000. That's a profit of £63,000, or 150% of the initial investment. Now, Scott will probably come on to explain that by their very nature, the risks associated with enterprise investment scheme investments are quite significant, and therefore, in addition to the CGT and income tax reliefs available, there's also relief available for losses should you incur a loss on the disposal of EIS shares. So, as the slide says here, if they're disposed at a loss, you take account of the income tax relief that's already been received, and then your net loss can be set against your other income or capital gains, depending upon your circumstances and which relief is best for you. But in the example here, again, we have a £100,000 investment. That let's say that becomes completely worthless. Well, we've already received income tax relief of £30,000, so our net loss is £70,000. For a 45% taxpayer, you could get further loss relief equating to £31,500. So actually, after claiming those reliefs, the post-tax loss is £38,500, which means that the exposure here for a 45% taxpayer is 38.5% of your initial investment. Business property relief for inheritance tax. This is a further relief that applies to EIS shares and not VCT investments that I'll come on to later. So shares in unquoted trading companies generally qualify for 100% business property relief, which means that after 2 years of ownership, their value is exempt from inheritance tax. Having said that, if the investments are replacing other qualifying assets, business property relief may apply immediately. Now, business property relief is given on the replacement property. So let's say you sell one qualifying asset and then acquire EIS shares. BPR is given on the replacement property immediately if the aggregated ownership periods total at least 2 of the last 5 years. This is sort of so-called BPR rollover, and it may be particularly relevant, for example, where an individual sells their business. Now, in that example, by selling the business, they turn an inheritance tax efficient asset into proceeds of sale, which are entirely exposed to inheritance tax. So to the extent the proceeds are invested into EIS, not only might they benefit from the income tax and CGT reliefs that I've explained a moment ago, but they can also keep the value outside of the scope of inheritance tax. Now, if someone can benefit from all of these reliefs, the effective cost of investment or investing into EIS can be reduced to almost zero in the right circumstances. And on the next slide, there is an example of how that works, but it's actually very similar to the first example in Patrick's kind of real life case study. So I'm going to skip over that slide and allow Patrick to run through his example where you can really see the value of EIS tax reliefs in the right circumstances.
Thanks, James. So what I'm going to try and do is go through some examples of how EIS that James has explained can be used in conjunction with other reliefs in certain scenarios to gain quite amazing tax reliefs if you have the right facts. So I've got 3 examples, each getting perhaps slightly more extreme, but I will just point out that even in example 3, which we'll get to in a while, I have had the vast majority of those facts in a real life example. So it does happen, albeit it's not appropriate for everyone, but it does happen. So in example one, we have a wealthy individual who has disposed of some investments that he has, making a £1 million capital gain. So if he does nothing at all, he's going to have to pay some capital gains tax, probably at 20% on that, so £200,000. He has a high income. He's a very wealthy chap, and he's paying more than £300,000 a year in income tax. Very lucky. So what can he do? Well, in this example, we're looking at those reliefs primarily. So he might be advised, and it might make sense to him from the investment point of view, to invest £1 million in enterprise investment scheme shares. Now, by doing that, he can defer his £1 million gain, as James mentioned earlier. And of course, he gets his £300,000 of income tax relief, the 30% relief. If he holds those shares until he dies, and he dies, say, 5 years later, then the tax relief he'll obtain is set out there in the table. So you'll have income tax of £300,000, capital gains tax of £200,000, which is not clawed back if you die owning the shares. As James' examples earlier showed, if you sell the shares before you die, then that deferred gain becomes chargeable. But if you die holding the EIS shares, then it becomes exempt. He'll also qualify for inheritance tax relief, the business property relief that James just mentioned. So that's another £400,000. So on an investment of £1 million in these risky EIS assets, this chap has managed to get £900,000 of tax relief. So you can argue, is it worth taking that risk? Well, you're only risking £100,000 on those facts, so it goes quite a long way to mitigating that risk you might be taking. Let's move it on a bit further now then. So this is an individual, and you can think our current Prime Minister's wife, if you like, and she was a non-dom who therefore was not paying tax on income or gains that she earned overseas that she didn't bring into the UK. So in this example, we have a non-domiciled individual who's no doubt taken advantage of that in the past, but he's now been here for more than 15 years, which means that the non-dom rules no longer apply, and he's now what we call deemed domiciled in the UK. Now, what that means is all his income and assets overseas are now potentially chargeable in the UK, not only to income tax and capital gains, but also to inheritance tax. So what might he be able to do using EIS? Well, he's got, let's assume he has £1 million of income sitting in an account offshore that he's never remitted into the UK. Now, he has no tax credit on that. He's managed to earn that money with no tax. He could have been in Saudi Arabia or somewhere. There are countries where you can earn large amounts of income without having to pay any local tax. So that's sitting there in an account. If he brings it into the UK with no other planning, he'll have to pay his UK tax rate on that as if it's income in the UK. This is a wealthy chap, so he'll have to pay at the highest possible rate of 45%. So he would have to pay £450,000 of income tax on that money if he brought it into the UK. But to encourage people such as this chap to bring some of their money to the UK and invest it, there is a relief called business investment relief. And that allows such individuals to bring such money into the UK, invest them in qualifying investments, and they won't have to pay that income tax. They have to meet all sorts of very tight rules on time. So if they sell it, for instance, they have to get the money back out of the UK very quickly, otherwise they'll have the tax bill. But it encourages them to bring their money here to invest to help UK business. It's possible for those qualifying investments to be enterprise investment scheme reliefs, shares. So that brings into account all the reliefs we've already discussed. So look at his situation. He has got £1 million sitting overseas, which he can't bring here without a 45% tax charge normally. And even if he leaves it where it is, if he dies owning it, he'll have to pay 40% inheritance tax on it. So he brings that money over. He invests it in EIS shares, which qualify for business investment relief. And his tax reliefs are set out on the slide. So he'll get the usual 30% on his investment for income tax. That's £300. He'll be able to claim £200,000 of capital gains tax deferral because, as in example one, he's made a disposal of shares in the UK and made a gain of £200,000. He'll get £400,000 of inheritance tax relief, and he won't have to pay that 45% on bringing that overseas income into the UK. So that's 45%, £450,000. So if you add all that lot up on his £1 million investment, he seems to have had £1.35 million worth of tax relief. That sounds quite staggering, but I think that's all correct. But it can actually get even better. If we move on to the final slide, and as I say, other than the property part of this, I've had these exact facts in a real case. So it does happen, not very often, but it does happen. So here we have the same individual. He's a non-dom but deemed dom individual. He's got that £1 million of cash overseas that he can't bring in without paying tax on it. But in addition, this chap has a UK trading company which would qualify for business property relief in normal circumstances, but included within this company is £1 million of cash that is not needed for its normal business operations. Now, those of you who might have attended previous webinars we've done on business property relief specifically may remember that where a company that otherwise qualifies for business property relief has more cash than it needs for normal business operation, that surplus cash becomes chargeable to inheritance tax. So that's the situation here. There's a company which qualifies, but it's got too much cash. Now, this individual has got plenty of income. He doesn't need any more, so he's not particularly willing to pay himself a dividend, which could, of course, solve his surplus cash problem. He could take the money out, reduce the surplus cash problem in the company, but then he'd have to pay tax on that dividend. So what does he do? There's one more thing I forgot to mention. He has got a property with £1 million of gain in it, which he wants to give to his kids. Now, although he wants to give it to his children, when you make a gift of property in the UK, it's treated as if you've sold it for capital gains tax purposes at market value. So even though he wants to give it to his children, there will be £1 million gain and you'll have to pay tax on that. So what can he do? So what we do is we bring that £1 million of income from overseas into the UK, claiming business investment relief, just like in the last example. We convince this chap to pay a dividend to himself of £1 million from his UK company to remove that surplus cash. So that problem goes away. The income tax he has to pay on that dividend is nearly 40% under the current rates, but not quite. So he will have to pay that, but against it, he'll have £300,000 of tax relief to set because of his £1 million investment in EIS. So that's £300,000 of tax relief there. The gain on the disposal of the property to his children, which will be taxed at corporation capital gains tax rates on property, would be £280,000. That can be deferred. The inheritance tax that he would have had to pay on the surplus cash in his company is now removed because there's no longer surplus cash in his company. Therefore, he saves £400,000 of inheritance tax there. The bringing of the overseas money into the UK is not subject to income tax because of business investment relief. So he saves £450,000 of tax there. And the £1 million investment in the EIS shares is itself qualified for business property relief, and therefore there's another £400,000 of inheritance tax relief there. So I appreciate it seems from this example that there's two lots of inheritance tax on the same investment, but weirdly that does seem to work because the first £400,000 is in respect of the surplus cash, which is taken out, so it's no longer there. Therefore, there is no inheritance tax. And the second £400,000 is on the EIS investment itself. So on an investment of £1 million, you could argue quite strongly that this individual has gained tax relief of £1.8 million. Now, if that's not pretty amazing tax relief, I don't know what is. And I would just say that while this is a rare set of circumstances, as I say, it does happen, it can happen. And this is all entirely within the rules. There's nothing suspect or avoidancy about this. It is just using the rules that are there for the very purpose of that they're being suggested to be used. So all I'm saying really is that in EIS, a very advantageous relief, yes, in its normal form, but when applied to tax planning, it can give some fairly spectacular results. And on that note, I'll hand you back to James.
Thank you, Patrick. I referred earlier to the seed enterprise investment scheme, and this wasn't really something we wanted to talk about in great detail today, but because it was introduced, I think in 2012-13 to complement the enterprise investment scheme, I just wanted to cover it briefly. Essentially, it provides enhanced reliefs. similar to those provided under EIS, but to encourage investment into very small early stage companies. It therefore follows that the risk associated with these investments is significant, and obviously more significant perhaps than those under EIS. As a result, we don't see an awful lot of this type of investment, but feel obviously you should be aware of at least the basics. So as I've said, just running through the slide here, as I've said, very early stage companies that have been trading for less than 2 years. So the company or the trade must have been operating for less than 2 years to potentially qualify. SEIS is restricted to companies with under 25 employees and less than £200,000 in gross assets, obviously significantly lower than the equivalent numbers for EIS. An individual investor can invest up to £100,000 per tax year, and on that £100,000 they can claim 50% income tax relief. So rather than 30% under EIS, 50% under SEIS. Again, you must have paid or have a liability of at least that amount to get the full benefit of the relief. There's a form of, rather than CGT deferral relief, SEIS investments qualify for reinvestment relief, which essentially provides a 50% CGT exemption. So let's say you realise a capital gain of £20,000 on the disposal of another asset. By investing £20,000 into SEIS, 10,000 of that 20,000 gain becomes exempt. The SEIS shares themselves are exempt from CGT after 3 years of ownership. And that's really all I wanted to say here on SEIS. I've done a table that kind of compares SEIS with EIS, so you can see the difference in the type and basically the size of companies that will qualify for SEIS compared to EIS. It's possible for companies to use both SEIS and EIS, and that might be particularly relevant where a company is looking for total investment exceeding the thresholds for SEIS, or perhaps a second round of investment after the normal 2-year threshold has passed for SEIS. But I won't dwell on this slide. It's there for your reference should you wish. I'm just going to spend the last probably 5 minutes talking about venture capital trusts, or VCTs, which are slightly different. They're investment companies that are listed on the stock exchange and are set up to invest in small UK businesses that meet certain criteria. So again, I'm not going to run through all the various conditions, but essentially you're investing in a single trust which itself invests in small UK businesses that qualify under the venture capital trust regime. Those small or early phase businesses are either unquoted or listed on the AIM market, and that's the stock exchange market for growth companies. AIM for tax purposes, or rather AIM shares for tax purposes, are treated as being unquoted, which is why they qualify for these reliefs. In terms of the tax reliefs that are available to investors, there are similarities between reliefs available for VCT investments and those available for EIS. Generally, EIS reliefs are greater. Well, there's more in the way of tax relief available for EIS than VCT investments. But for VCTs, income tax relief of 30% is available on up to a £200,000 annual investment, provided the shares are held for 5 years. So someone subscribes for £200,000 of VCT investments, they can claim an income tax reduction of £60,000 in the year of investment, but that relief is clawed back if they sell those VCT investments within 5 years. Dividends received on VCT shares are exempt, so no income tax is payable, and no capital gains tax is payable on disposals by individuals of ordinary shares in VCTs. The second point on the slide, though, is just to confirm that reliefs are available to individuals, but not other investors, such as trustees or companies, for example. The income tax exemption on dividends and the CGT disposal, or the CGT exemption on disposal, are available to anyone who sells, or rather holds and sells VCT shares, even if they've acquired those shares second hand. Whilst the front end income tax relief, that's the 30% relief on subscriptions, is only available to those who subscribe for new shares. So I suppose one of the significant differences between VCTs and EIS is that VCTs do not qualify for IHT reliefs. Let's look at an example here. So in the example, we've got Mr. X, a client who invests £100,000 in a VCT, which he or she intends to hold for 5 years. Okay, their tax liability for the year of investment is over £30,000, and therefore they can deduct £30,000 from their tax liability because of the investment. If we then assume, and this is not unreasonable, I'm told, if we then assume the VCT pays a 5% dividend every year over the 5 years of ownership, and then he sells the VCT shares after 5 years for the same price as they were subscribed for, the return is as set out on the table here. And I've presented this kind of year on year, showing the initial tax relief of £30,000 available following the subscription, the £5,000 dividend coming in each year, and then the sale proceeds of £100,000, which means the profit over 5 years, or the total return on the £100,000 investment, is £55,000. That's a 55% tax-free return over 5 years. And for a 45% taxpayer, that basically equates to a 20% pre-tax annual return. You know, they'd have to get a 20% return on that £100,000 if it were taxable to match the reliefs or the return that they obtain by making VCT investments. The final couple of slides here is just considering how VCTs might be an alternative to pensions. And you recall I said at the start that there are sort of a couple of problematic areas for high earners regarding pension contributions. I'm not sure this slide particularly follows, but I'll try and explain it. So, you know, imagine a high-flying city lawyer, as I've put it on the slide here, who finds himself at age 40 on an income of £500,000 and with only £200,000 in his pension fund. So clearly wanting to make pension contributions, but is prevented from doing so because his annual allowance is reduced to just £4,000. So in that situation, he might resolve as follows: put £28,266 per annum into a VCT, make £4,000 of pension contributions, because that's the maximum he can make in any given tax year. The total cost of that after the tax reliefs is £22,000 per annum, which is what the cost of a £40,000 pension contribution would have been had his annual allowance not been restricted. He then resolves to reinvest all the VCT dividends, assuming, of course, they're at 5%. That's not obviously guaranteed. He also resolves to reinvest all VCT sale proceeds into further EIS investments, assuming a sale every 5 years at cost. So I'm assuming in my example here that there's no profit or loss, or capital profit or loss on the investments themselves. And I assume that he will invest all the tax relief on those new VCT investments into further VCT investments. So after 5 years, he sells the original investments, reinvests that capital into further VCTs, and reinvests the income tax relief that he obtains on the new subscriptions. If that's done as I've described, and assuming my assumptions play out, after 13 years, the maximum £200,000 per annum VCT investment up to age 60 becomes self-funding, and that is in return for total fresh money being invested in VCTs over that period of £361,000. On the pension side, if we assume a 6% growth and 4k annual pension contributions, the pension fund will be 800k on retirement, and after a £200,000 lump sum, he'll be left with 600k in his pension. At age 60, he will have the 200k lump sum from the pension, 566k of money withdrawn tax-free from VCT investments, and a £1 million VCT fund, which will then pay dividends totaling 150k between age 60 and 65, and then he sells his VCT investments and has £1 million for his retirement. Now, you're going to have to take my word for those numbers, but I have done the maths and it does work out. So you can see that whilst there are risks, obvious risks from a financial perspective in investing in such things, the tax reliefs are so significant that in the right circumstances, and particularly in this final example for high earning individuals who are unable to make, for example, significant pension contributions that they would otherwise wish to, it suddenly becomes a very, very viable alternative. And on that note, I'll hand over to Scott Newbold, who will talk you through the benefits and risks associated with these types of investments.
Perfect. Thanks, James. As we've pointed out, there are a number of tax benefits from these types of investment. But one thing that we need to consider alongside that are the risks involved. So with VCT and EIS investments, they are into smaller companies. So from an investment viewpoint, they will have a higher level of risk than, say, a big blue chip equity. So that's one thing to consider with these investments. One way which the VCT and EIS providers try to navigate this is through having seats on the board of these companies that they're investing into. That's a way that they can help to monitor decisions which are being made within the business, and so that they can still feel comfortable investing in those businesses, as well as providing an element of guidance to the business owners to help ultimately grow the business and your investment. With VCTs, you're not just investing into one company either. So as I've said at the bottom bullet point, typically at the minute we're seeing between 20 to 70 different companies within a VCT. Obviously that will depend on the VCT you're invested into, the size of the fund and things like that. And the same with EIS. EIS investments are made into earlier stage than VCT. So they might have sort of 10, 12 companies, and there will be more seed investment early stage, whereas with a VCT, you might find that these are a bit of later stage funding, and sometimes they're often still profitable businesses at that point. So on the next slide, I've got a little bit more about the stages of development. So there you've got what we've mentioned in terms of the later stage, AIM listed, the seed stage. So they're typically your pre-revenue companies at very early stage, just been set up, often engaging in research and development activities. With those types, again, that's more going to be your EIS, but you will find some VCTs invest at that stage. And then in early stage, you're going to find a bit of a crossover between the two different investment types. Both investment types will be investing in this stage, and these are typically post-revenues companies. They're not profitable yet, but within the next couple of years, the VCT and EIS providers think that they will be profitable. And then moving into the later stage, again, this is more where you're going to see your VCT investment than your EIS, and they are more established businesses, often profitable for at least a year, maybe 2 years, and it's just a later round of funding for those businesses. A little bit further, so I've provided a bit more detail, and this is information from a research tool that we use on the financial planning side as of last week. So as you can see, for the VCTs in the current market, you've got 5 VCTs invested at seed stage, 28 in that early stage, and 23 in the later stage. So as we've said, they're a little bit more down the investment cycle. With your EIS, you see you've got the 21 funds at the seed stage, so much earlier, and 55 in the early stage. So there's a little bit more in the early investment side, and typically what we see is EISs will be, from a risk viewpoint, they will be that higher risk than a VCT because they are at that earlier stage. But like we've said earlier, there are more tax breaks available for an EIS investment rather than a VCT investment. Moving on to typical returns. Again, this is information that I looked at last week using the provider that we use for this type of research. And as we've said, with all investment types, returns are in no way guaranteed. And because these are investments into earlier stage companies, there are going to be higher levels of risk. So based on the VCTs currently available, the 5-year average performance is 29.4% over a 5-year period. That is including the dividends received. So with a lot of VCT investments at the minute, what you'll find is a lot of the return that will be seen will be through the dividends produced, but there are some VCTs where it will be a bit of dividend and a little bit of capital growth as well. So looking at the best performing, that one actually did have dividend and capital growth, so it performed at 90%, which is quite good for an investment, especially over a 5-year time frame. And then looking at the worst performing, that was minus 26.5. Again, that was predominantly through a fall in the capital value, but it had been producing dividends as well. When looking at that alongside the tax reliefs you've received from a VCT, if you've got that 30% tax relief on your income tax initially, you're still in profit, although it is a small profit at that side. So although if you're in the worst performing one so far, you would have still, net of tax reliefs, been in a slightly better position. The typical returns on EIS, these are measured slightly differently, so it's dependent on realised and unrealised gains within the EIS. Again, with these types of investments being very early stage, within the 10 companies that an EIS invests into, they'd expect a couple of those companies to fail because they would be at the seed stage. They are then expecting probably half to return a small return on your initial capital, and then what they're targeting is the couple of companies within there that are going to return 10 times your initial investment. So a really big investment to outweigh the companies that failed. As well as the companies that have failed, you do get that loss relief that we mentioned earlier. So it's you've got a small benefit there, although that element of your capital may have been lost through the company not making it. So just going back to that slide, just that last point, the so typical returns that are being reported within EISs at the minute. So this won't include unrealised investments or failed investments, is between 0.6 times your investment amount and 2.6 times. So the realised gains, like you can see there, are quite good, but within those investments you will have unrealised investments and failed investments. So moving on to the fundamentals of VCT, EIS and EIS providers. So Octopus, they are very large within VCT investments. and we can use them as a bit of an example. So depending on the type of investment selected will depend on how quickly the money is deployed. So with a VCT, it will be typically within the same tax year. As James mentioned earlier, with the EIS, you do have the ability to carry back to a previous tax year. And when you invest money in an EIS, it's not that all of the money will be invested at once. So you might invest the money in a January in one tax year. The actual money might not get deployed for 12 to 18 months. So you could be certainly 1-2 tax years down the line. And that's why you have that ability to carry back to previous tax years. Like we say, with VCTs, it's typically they will be made by the 5th of April so that you are claiming the tax relief within the same tax year. With the VCT, they will issue share certificates. So you have these to provide evidence that the investment has been made. And with an EIS, you will receive EIS 3 certificates. Again, because the money is not necessarily invested at one time, it might take a period of time for these to be received. And so you've got details of the investment made, and you can prove this when you're then claiming your tax reliefs. In terms of claiming the tax reliefs, James and Patrick will be able to explain more on this if there's any further questions. But in terms of doing that, that can typically be done through your self-assessment or tax return, through an adjustment to your tax code, or by sending the certificates, so whether that's the VCT share certificate or the EIS 3 with a P60 to your local tax office or to the HMRC tax office.
Thanks, Scott. I think we're at the point where if there are any questions, we will happily take them and see if we can answer them. I don't know if there are any questions as yet.
There's no questions in the Q&A as yet, but if anyone has them, do put them in. We've had a few come through from email beforehand, so I'll go through those. These were obviously raised before, so you might have covered it, but hopefully go into a bit more detail. With the deferral of the capital gains tax, when that comes back into charge, will that be charged at the current rate, or is that at risk of if the capital gains tax rates change? How does that work?
Yeah, so I'll answer this, Patrick. The gains come back into charge at the prevailing capital gains tax rate at the time, unless the gains were those qualifying for business asset disposal relief. So if someone disposes of a business asset on which they would ordinarily pay CGT at 10%, then that 10% rate is preserved when the deferred gain comes back into charge. Otherwise, the deferred gain comes back into charge at the main rate, which is currently 20%. Now, on the one hand, that provides an opportunity, because if the deferred gain was a residential property disposal gain, that would ordinarily be charged at 28%. But by deferring the gain into EIS and then it coming back into charge, you can reduce that rate to 20%. On the other hand, though, there's obviously the risk of CGT rates increasing, and that's probably a real risk at the moment. So certainly clients looking at EIS investments at the moment will be thinking about whether or not they will actually take advantage of the CGT deferral. It might be that, if there's an expectation that CGT rates go up, or indeed if we do see CGT rates go up, perhaps even on Thursday, then they might make the decision that, well, actually, if I'm likely to dispose of these shares and the gain come back into charge anyway, then I'll just pay the tax now at 20% because it's quite a good rate. If clients are in the situation that they are likely to hold the EIS investments or replacement EIS investments upon their death, then the rate of tax on the deferred gain is less relevant, because of course the deferred gain dies with you. So hopefully that makes sense.
Thanks, James. Any more?
There was just one more. We're obviously discussing the three sort of different ones here with EIS, CDIS and VCT. Is there sort of an order of priority of when you would say do that one first and that one, or would it just be a mixture depending on circumstances?
In terms of from our side, from the financial planning side, that would be a case-by-case scenario, I guess. Like I say, from a risk viewpoint, if you're doing it that way, you would probably be looking at your VCT investment first, then EIS, just working the way down the risk grades. But it's going to depend from our side on circumstances, whether the client has gains that they're looking to defer, whether they have an inheritance tax liability that they're looking to negate, or whether they're just looking to reclaim some of the income tax in the current tax year.
Yes, I would just say that from the planning point of view, if we go back to the slides I was doing, then obviously it depends what you're looking to gain. So in those particular examples, the individual was looking to get income tax relief, inheritance tax relief, and capital gains tax relief, and to do that in the amounts that that person wanted to do, it would need to be EIS. But as Scott said, if you want to take less risk and you haven't got those requirements, then a VCT is probably the place to start in terms of risk.
Okay. So it's probably a good idea to speak to both your tax advisor and your financial planner at the same time to work out, make sure you're doing the correct thing for what you want to achieve.
Exactly that, and I think it's always worth looking at the overall scenario of the client. Again, going back to the slides I was doing, it shows that what could be seen as in isolation as an adventurous investment can turn out to be something that has huge benefits when combined with planning overall. And it depends on the fact, but I think that definitely talking to your advisors, both on the tax side and the financial planning side, makes a lot of sense in this sort of area.
We obviously just discussed the maximum levels of investment to obtain the relief. Is there sort of like a minimum level where you think it's beneficial to dip into these areas, or just start at whatever level you can?
From our side, a lot of the providers that we use on the financial planning side will have a minimum investment amount. With the VCTs having a lower maximum amount, they typically have a lower minimum as well. So at present, you'd probably see around £3,000 as the minimum that a VCT provider would take as an investment. On the EIS and SEIS side, you'd probably be looking more at 25,000 as a minimum. But that's not to say that some providers may not look at investment lower than that, but that's typically what we're seeing in the market at present.
So that's all the questions we had through before. I'm not having anything coming through on the question and answers at the moment.
Okay, well, thanks, Kat. I hope that means that we've answered most of your questions in the presentation, but obviously if there are other questions that you think of, feel free to fire an email in to us and we'll see what we can do. Otherwise, it just remains for me to say thank you very much for attending. We are continuing our series of these webinars, so there will be more. I can't remember what the next one is, but there'll be another one coming up in about a month's time. So please look out for those. And otherwise, thanks very much.